Hello students, welcome to Veranda IAS. From the current affairs of economy, in this session we are going to discuss about additional tier 1 bonds. The learning objective of this particular session will be to discuss additional tier 1 bond. Then we will analyze the news related to AT1 bond, that is again additional tier 1 bond. Then we will mention the action taken by the SEBI, that is Securities and Exchange Board of India. Then we will examine the effect on mutual funds, and then we will further discuss the impact on the banks. We will also discuss and analyze the decision taken by the Finance Ministry in this regard. So let's begin first by introducing or understanding the concept of an additional tier 1 bond. Now, AT1 bonds. Now, we in India we know there are different types of things in when it comes to the markets. Okay, capital markets or stock markets. There are various bonds. There are shares. There are equities and all those things. So bonds also play a very significant role when it comes to the market. So the AT1 bond or we can say the additional tier 1 bonds are the tier 1 bonds with one extra layer. These are perpetual unsecured bonds. So this point is important, one extra layer, but one extra layer, we'll explore that, what it is. But these are perpetual unsecured bonds. So this is very important, unsecured bonds. In other words, the bonds are not due at any point in the future. So like bonds, we have some date to that bond. For example, if you purchase any particular bond, they will say the maturity of this bond will be after 10 years, 5 years, 1 year, whatever it may be. But these type of bonds, they basically don't have what you can say, they are not due at any point in the future. That means they are not due in the coming times. That means they don't have a maturity date. So because of they not having maturity date, they are a bit kind of an riskier bonds. But then we'll see that they include a call option that allows banks to repurchase bonds from the investors. So they have a call option, that is again you can highlight that, and that allows banks to repurchase this. So banks will be allowed to repurchase this from the investors. These bonds are typically used by banks to bolster their core or tier 1 capital. So that is another one, what we can say, one significant factor into that. Now, if the banks are having these kind of bonds, so obviously these bonds also have value. So because of that value, what will happen? Their capital will increase. So tier 1 capital will increase. Now, AT1 bonds are subordinate to all other debt and only senior to common equity. Further, mutual funds are among the major holders of perpetual debt instruments, owning about rupees 35,000 crore of the rupees 90,000 crore in the outstanding extra tier 1 bond insurances or issuances. So that is what we can say is about the additional tier 1 bond. Now further, why it was in news, so we will look into that. Now in March 2020, the Association of Mutual Funds in India wrote to the Reserve Bank of India and Securities and Exchange Board of India requesting that RBI and SEBI allow fund houses to temporarily write down additional tier 1 bonds of Yes Bank in order to avoid a significant drop in the net asset value of the schemes that hold such bonds. So we all know Yes Bank, which have suffered a lot, and because of this its value in the stock markets and all those things went down. Even the investors suffered, of the investors who had invested in the Yes Bank. At the same time, the depositors were there in the Yes Bank, they also suffered. So in that case, we can say somewhere or the other Yes Bank collapsed, but then again it was found out the government initiated certain measures, and because of that now it is still holding. But technically the point is what, they were having these bonds. Now if these bonds were there, now these mutual funds and the SEBI basically, or the investors basically of the mutual funds, they requested that these bonds temporarily write down. So writing down, write off, when we say in loan, that means what? That the bank has considered now this loan is like unrecoverable. Okay, so written off is like something, it's not like they have given the clean sheet, okay, you don't need to pay this money, but it is just like written off. That means the banks will not calculate that amount or that thing in which profits and losses or whatever it is. So it is just written out from other audit books and all those things. So that will not be considered. So that was asked by this Association of Mutual Funds with regards to the Yes Bank. And why that was? Because if you add these bonds into the Yes Bank's audits and all those things, you will find that Yes Bank again will have significant or net level of debts and all those things. So there will be a significant drop in the net asset value of schemes that hold such bonds. So that was asked by the SEBI, this association, to write it off. Write it off again means that you just don't consider these things or these bonds, loans and all those things into the audit book. So you just think that okay, these are not the part, now we will not calculate this into our profit or loss, whatever it is. So that is writing off. Now, what is the action taken by the SEBI? The SEBI has instructed mutual funds to evaluate these perpetual bonds on a 100-year basis. So, 100-year basis, perpetual bonds on 100-year basis means what? So, after 100 years, their maturity will be there. Now, this is very long period. Now, this effectively means that money managers must assume these bonds will be redeemed in 100 years. So, whoever the people are there. So, again, these are not bonds for the ordinary peoples and all those things. These are the instruments for the bankings and the investors or the mutual funds and mutual fund investors and all. So redeemed in 100 years. So that actually technically what it means. So they are not going to be redeemed in near future. So their maturity has been extended. So their liability also has been extended, because if they are going to be matured in 10 years or 20 years, then obviously they have to be accounted for. But if they are to be redeemed in 100 years, they don't have to be accounted for. So additionally, the regulator instructed mutual funds to cap bond holding at 10% of the scheme's asset. The SEBI believes that these instruments may be riskier than conventional debt instruments. So this is what the action of the SEBI is. Then further, SEBI is likely to have taken this decision following the RBI's approval of rupees 8,400 crore write-off on additional tier 1 bonds issued by the Yes Bank Limited following its rescue by the State Bank of India. Yes, we know Yes Bank collapsed and then it was rescued by the State Bank of India, and then in that cases obviously there was some loans or debts were there on the bank. So that almost rupees 8,400 crore were written off, or these were the written off on which basis? Because they were holding the additional tier 1 bonds. So because of that this was written off. Fine. Now what is the effect on the mutual fund? Now historically, this is important actually for the exam point from the exam point of view. Mutual funds have considered the call option expiration date on additional tier 1 bonds as the maturity date. So we have, for every kind of bond, we have a maturity date. That means after that you can redeem those bonds, whatever the value of it may be at that time. So they have considered this call option expiration, whatever the date is there of the call option expiration. We have in call and put options, we have expiries. So these expiration date of the bonds as the maturity date. Now what is the thing? If these bonds are now classified as 100-year bond, the risk associated with them increases as they become ultra long term. Okay, like this is like 100 years, who is going to be there after 100 years? So that is the question. So now once you are taking these bonds, now of their maturity and all those things, you can do at 100-year terms, 100-year bonds. So they are become ultra long term bonds. This might also result in market volatility for these bonds as the risk grows and the rates on these bonds rise. So that is another important thing that we have to see. Now bond yields and bond prices move in opposing directions, and so a greater yield will push down the price of the bond, reducing the net asset value of the mutual funds that own these bonds. Now these bonds are owned by the mutual funds. Again, I told you these bonds are not owned by the ordinary peoples and all those things. So what happens? So whatever the bond is going to give you the returns, and at the same time whatever price you have received. So now they move in opposite direction. That means that they are contrary to each other. So in this case, what is the thing? So they are going to mature after the 100 years. So greater yield will push down the prices. So if you are having a greater yield, that means greater profit on that particular bond, then what is going to happen? The price of the bond is going down. Okay, and that will reduce. Okay, mutual funds asset value is whatever assets they have and whatever the value it is assigned to it. Now that will reduce the net asset value of mutual funds that own this bond. So that is the most important effect on the mutual funds. Further impacts on the bank. The additional tier 1 bonds have emerged as the preferred capital vehicle for state bank seeking to shore up their capital ratios. Okay, if mutual fund investors are restricted from investing in such bonds, banks may struggle to obtain capital at a time when bad assets are growing. So in the banks and NPAs and all those things, if they are increasing, and if these values are mutual funds institutions are not allowed to purchase these things, then the banks may have the issues regarding the assets that they possess. Further, what is the decision taken by the Finance Ministry? The Finance Ministry has requested the deletion of SEBI mandated valuation standards for AT1, that is additional tier 1 bonds held by the mutual fund houses, claiming that they might result in mutual funds incurring losses and abandoning these bonds. So if they are, if the mutual funds and all those things, if they are going to suffer from this, what will happen? They will abandon these bonds, and once these bonds are abandoned, what will happen? It will jeopardize the public sector undertakings, banks. capital raising efforts. So public sector bank, they raise the capital through the mutual funds and all those things. But if these mutual fund assets and all those things, if they are incurring losses with these bonds, so then they will just give away those bonds. And if they are giving up those bonds, their asset values will be reduced. And if their asset values are reduced, then they will not be able to fund. Okay, and most importantly, the state banks, that is the public sector undertaking banks specifically, they raise the money from the mutual funds and all. So they will be jeopardizing the public sector undertaking banks. The government does not want to interrupt banks' capital mobilization efforts at a time when two PSU banks are slated for privatization. So this is important. Now we all know that government is more pro for the privatization of many public sector undertakings. And if this is done, then that will hamper the efforts of the privatization of these banks, because their values, see, banks' values, if they are reduced, then their stock values and all those things will get reduced. So that is the important thing. Now to summarize what we have learnt additional tier 1 bond, then we went down to study the news related to the AT1 bond, then we studied the action taken by the SEBI, and then we studied effects on the mutual fund, which is very important from the exam point of view, and then impact on the banks. So if the banks are having this and if mutual funds are disowning that, then banks will be impacted negatively. And decision taken by the finance ministry was the one thing that we learned at the last. So with that, I hope you have understood whatever we have discussed in this particular session. That's it for this session. See you in another one. Thank you.